Jeffrey Schwarte, who's a portfolio manager at Principal Global Investors, where he helps oversee about $258 billion in assets, joins us on the program. Jeff, good to have you back. Whoa, lots of concerns from the European side. You got a disappointing Italian bond auction. You have Spain struggling to recapitalize its banks, and an anti-austerity party in Greece also taking one recent poll. What do you do?
Well, Susan, we certainly have been caught in a negative feedback loop with ongoing challenges in Europe. We got some information overnight that there would not be another 2008 type stimulus package coming out of China. We've got ongoing challenges in the U.S. with the fiscal cliff coming up. And certainly there's a lot to be worried about recently with the stock market and the financial markets.
Yeah, there is lots to worry about. Now, I know you're a U.S. equities portfolio manager, but what are you pricing in terms of, say, volatility, in terms of impacts possibly from the European side?
Sure. You know, we've studied the situation closely for the last couple of years, and just as a fact, European recession has never pushed the U.S. into a recession. Currently, 17% of earnings for the S&P 500 come from Europe. About two-thirds of those are within the energy, industrials, and technology sectors. So as we're studying the situation in Europe, we're understanding what the exposures are of the companies that we're investing in. And in the grand scheme of things, the U.S. is somewhat immune to the issues in Europe, but not totally immune. So we're watching it very closely.
Okay, you are watching it very closely, as is the world, Jeff. So can European leaders continue to hold off disaster, or are you preparing maybe for a Euro exit at some point in the next few months?
Well, it's hard to say. It's an ongoing fluid situation. I'm certainly not an expert on what's happening with the congressional leadership and the policymakers in Europe, but the markets aren't liking what they're seeing as of late. Thus, you're seeing the sell-off in commodities, which is actually a good thing for the U.S. consumer. We are seeing a strengthening dollar. We are seeing prices at the pump lower. We are seeing oil prices drop, which for the U.S. consumer is a good thing. It gives us an additional stimulus to the consumption pattern of the U.S. consumer.
Yeah, and are you rushing into the safety of treasuries right now? Look at the 10-year yield. My goodness, record lows at this point.
Yeah, it is amazing to watch. I mean, S&P 500 dividend yield is 2.1% right now. 58% of the companies in the S&P 500 have a yield greater than the 10-year treasury at 1.61%.
Yeah.
We're seeing all-time lows in mortgage rates, and it's really an interesting period here. We saw this back in 1958, and we saw it in 2008 and 2011. Both those times in which this occurred was an attractive entry point into the S&P 500 stock market.
So what are you saying, Jeff, that you buy when there's panic?
Well, I do. I think there's a lot of emotion in the marketplace right now. Investors that are long-term oriented, that can stomach some near-term volatility in the short term, should be benefited from appreciation in the stock market as we get through some of the things that have caused this. Now, the month of June is going to be significant. We get non-farm payrolls on Friday. We get manufacturing numbers on Friday. We also get another Greek election in mid-June. We get Supreme Court ruling on managed care, or Obamacare late June, and then we get the expiration of Operation Twist. So June is going to be an interesting month, to say the least. And then we also have the fiscal cliff coming up at the end of the year, which is to the tune of $400 billion headwind, or 1 to 2% of GDP. So a lot to be watched right now, but I think for the investors that are long-term oriented, entry points in June and July would be very attractive for long-term investors.
Yeah, so Jeff, as a portfolio manager, what are you doing with your dollars right now? Are you going in to bottom pick at these levels?
Well, we're certainly making our list of preferred cyclical names as we see valuations become more and more attractive. S&P is about 12 times next year's earnings. I would highlight a couple areas that we're invested in right now would be technology. We see cash balances of tech companies right around 20% of the total market cap, so we see plenty of firepower to increase share repurchase programs as well as increased dividends. Our two favorite stocks there would be Apple and EMC. And then I would highlight more of a U.S.-centric idea within the telecommunications sector. Verizon Telecom trades at 15 times next year's earnings with a 5.3% dividend yield, 8% free cash flow story. They are improving their margins by putting in additional charges for upgrading their phones for users. So we really like what's going on with Verizon. No international exposure, all U.S.-centric. And consumers are really addicted to their smartphones, so we think that's a pretty safe place to hide right now.
Yeah, that's a good point, Jeff. Hey, thank you so much for your time today. Good talking to you as always. Jeffrey Schwarte of Principal Global Investors.